Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. On June 4th, Chairman of the Federal Reserve Jay Powell said the Federal Reserve is paying attention to the negotiations between China and the United States, is obviously monitoring how the U.S. economy is performing, and would act to sustain the economic recovery that has turned 10 years of age in June. The financial markets now have priced in the probability of an 88% chance that the Fed will act no later than July, and a high percentage probability that the Fed will lower the federal funds rate 3 times before the end of 2019. Based on the current level of economic activity, I think the U.S. economy is growing somewhere between 1.5% and 2%. The only thing that would precipitate the need for 3 rate cuts before the end of the year would be if President Trump levies additional tariffs on the $300 billion of Chinese imports that aren't currently subject to levies. But what that would mean is the economy would slow materially, corporate earnings would obviously turn south and weaken, and if we look, you can see that the forward PE ratio of the S&P 500 is nowhere near being quote-unquote cheap, and during the declines in late 2015 and early 2016, as the S&P declined, the forward PE also declined. And you can see that last year in the fourth quarter, the forward PE dropped from 18 to 15. So about a 16% decline attributed to the S&P merely came because the forward PE ratio dropped. So if the forward PE ratio dropped from its current level of about 17 down to 15, that alone would cause the S&P to drop by 11% on top of whatever else earnings would add to that decline. The chart pattern of the S&P 500 suggests a decline of 20% could easily develop before the end of 2019. From the March 2009 low, the high in January of 2018, I believe, is wave 3 of a secular bull market. The RSI for the S&P 500, its weekly RSI, hit the highest level in history at 85 in January of 2018. So that marks the top of wave 3. Since then, the S&P has been tracing out a broadening top formation, which looks like a megaphone, which is why it often is called that. Although the S&P could potentially move up to around 3,000, which is about 4% higher than it currently is at, the downside risk is that the S&P will decline below the low of December at 2347. So the downside risk is more than 18%, and the upside reward is about 4%. So the risk reward is obviously not very attractive. It would take a close above 3020 that is sustained to negate this broadening top formation. My technical analysis provided a buy signal back on January 16th, the major trend indicator, when the S&P was at 2616. The U.S. Tactical Sector Rotation Program invests in the top 5 sectors within the S&P as measured by their relative strength. On May 1st, the S&P made a new high above the high last September, so it fulfilled the minimum requirement of the triangle. Technical weakness in early May suggested that the market was becoming vulnerable to a decline. I reduced exposure in the sector rotation program from 100% to 50% on May 16th and to 25% on the opening of June 11th. I think there is the real risk that the S&P could revisit the lows of December 25th from last year in coming months. Until then, may good things happen to you.